How's it going, guys? Welcome back to the channel. In this video here, we're going to be doing an analysis on GM. You heard about this company, you've probably seen their cars, you probably drive one or own one. Without further ado, let's jump right into the intro and get to looking at GM. Let's jump straight into it. Looking at the company metrics, let's do a comparison of the PE ratios and everything else that follows. PE 725 to 326. Yeah, we like that. We want that to be under 22.5. We have that. EPS 6.77 to 3.76. Higher EPS over the 5-year average. Amazing. ROE, we want this to be over 15%, and we have that on our trailing 12 months. And we're beating out our 5-year average, but that is hovering around 11.35. Not going to win any points for me there. Profit margin 7.89% compared to 4.17%. We like that. Revenue $127 billion. Free cash flow is negative at $692 million. Our 5-year average has also been negative as well. All right, not looking too happy there. 5-year return on invested capital is 4.81%, and our return on invested capital for the trailing 12 months is 5.47%. We don't have an Altman Z-score or a Piotrowski score. Not too happy with these metrics at the moment. I do like the PE ratio currently. I'm a fan of the EPS, and the current return on equity, but I wish the 5-year was higher. Net income and free cash flow mainly have not been too impressive, as well as our return on invested capital. Let's jump into our financial evaluations segment here, and let's grade this company. Right now, we're pulling a 3, so let's see and go into detail of what makes GM have that numeric. So yeah, as we said earlier, our 5-year PE ratio is 3.26. We want that under 22.5. It is positive. It's very low. That's one positive there. A current ratio, we want this to be 1.5 or higher. We got 1.10. Not the worst, but it's going to get a 0 from me because we want that to be 1.5 just to have enough assets on hand to cover those liabilities. ROE, it's 11.35%, 11.35%. We want that to be 15%. Oh, sorry, we want that to be 15% or higher. We don't have that. EPS growth, there is a large EPS growth over the last 5 years. Great to see that. So it gets a point. Debt to equity is really concerning. We want this to be under 50%, folks. We're seeing that at 128%. That means they have more debt. Their financial leverage is mostly through debt and not through equity within the business. That is somewhat reflective because of the return on invested capital. We can kind of see that. And somewhat low return on equity. Share dilution. We want this number to be the same or decreasing. We have a 1.3% increase in shares. We want GM to lower their share dilution, not increase it. So it's going to get a 0 from me. 5-year net income growth. It's good. We're seeing some income growth. The last 5 years, 360%. That's a positive. 5-year free cash flow growth has been decreasing. We want this to be increasing, folks, and as we're currently standing, it is in the negatives. We don't want that. We want to see positive cash flow. 5-year return on invested capital, 4.81%. We want that to be over 10. We don't have that on either the trailing 12 months or the 5-year average. And then finally, 5-year revenue growth is negative 5%. We want to see this growing, and unfortunately, we don't have that. As it stands now, GM, if I would skip doing the price analysis, but because this doesn't seem like a company worth looking into at the current moment. But I'm here to deliver you guys the content that you're looking for. And if you're liking the video so far, make sure you hit the like button and the subscribe button. It helps out the channel a lot, and it makes me feel warm and fuzzy inside. So without further ado, let's jump into the price analysis category and try to see a fair price to pay for GM. I think, spoiler alert, I don't think it's going to be quite high. And currently where it stands now at $48.60 at the time of recording this video, I wouldn't be surprised if that number is incredibly low, or incredibly low in our calculation, and this is incredibly overpriced. Anyways, I digress. Let's jump into it. Revenue growth. I'm gonna put -2, 0, and 2. You're probably wondering why I'm putting a -2 here. Well, they have had a -5% revenue growth over the last 5 years, and a 10-year revenue growth is a -1%. So 2 is not I don't think a crazy number to look at, and I'll keep the moderate at just keeping the revenue the same. Profit margin. We'll do 3, 3.5, and finally 4. Free cash flow margin, we have negative numbers across the board, folks. So I'm not a huge fan of that. So I'm going to go 0, 2, and 4. Just in case. Price to free cash flow, I'm going to go 0, 5, no, 0, 3, and 5. And PE ratio. I'm gonna say if we hover around the 7 mark, I wouldn't be surprised if we go 4. Let's go 4.5, 5.5, 6.5. Desired return, we always do 13%. I like number 13, and oh man. Okay. Not looking too good, folks. Not looking too good. Our average price is $13. Discounted cash flow and price to free cash flow is getting 0. Obviously, and maybe I should possibly just change that to 1. Let's see if that changed anything. No, it does not. It does not do anything. So I'll keep that the same. This is probably the category most, I guess, looking at our moderate category here, this one's probably the one we want to probably pay the most attention to, because this is assuming our revenue numbers stay the same and they don't decrease. Profit margin stays at 3.5%, something that to be expected. This anomaly here with the 7.89% might be due to the fact that people are. You know what? I don't know. I really don't have an answer for that question, actually, because there is a car shortage. There's all this discrepancies with vehicles being put on the market. So I don't know how to really justify this number just yet. But over a 10-year and 5-year, this 3.5 makes sense to me, because it gives us a little bit of a margin of safety. It's a conservative estimate of where they could be going in the next 10 years or so. Free cash flow margin, I'm pulling this number out of a hat because this hasn't been done. They have negative free cash flow, obviously, because they've taken on more debt within the company and not building up equity, and I have no idea why their free cash flow numbers are so low. So we'll keep that at 2%. Price to free cash flow, I'm keeping it at a very conservative number of 3. I know it's currently -10. Because of the negative free cash flow. So 3 is a wish list number. Most likely, it may probably make more sense to put 0 in this category, but that would change that numeric down to $10 compared to 11.30. PE ratio of a moderate 5.5. We have it at 7.25, and as we see here, our 5-year average has been 3.26. So nothing strange about that. Yeah. My thoughts on GM would be to completely avoid it for now. It's definitely it's overpriced currently where it's staying. I want to see, hold on, cash flow. Let's look at the cash flow statements. Free cash flow. Yeah, it's just negative across the board, folks. We had a positive year in 2013 and 2012. And then after that, it's just been, wow, just absolutely negative across the board. Not really, you can't really see because my big head is blocking the way, but there it is, this number down here. Yeah, not a fan. not a fan of GM. I would be wary if you're thinking about getting into this one. Obviously, this is all just entertainment and not actual financial advice. But from what I've looked at here, GM isn't for me. I like their cars though. Favorite car from them, 1968 Pontiac GTO. Shout out if you know that one. If you enjoyed this video, make sure you hit the like button and the subscribe button. If you like the software I'm using here in front of you, this could be yours. It's on its way to becoming its own mobile or computer app. It's in production. But if you're enjoying this, send me a message. Send me a comment down below of if you're interested in this software, as well as companies you would like to see evaluated. I'll plug them through and we can discuss that together. And with that, folks, I will see you in the next video. Thank you so much for watching.